Hello and welcome back to the channel. Today, we're diving deep into an earnings report that's making some serious waves in the market. We're talking about Yangzijiang Shipbuilding, a giant in the industry, which just posted a staggering 37% jump in net profit for the first half of 2025, hitting a record $4.2 billion. What's even more impressive, their shipbuilding margin soared to a new high of 35%. In a world grappling with economic uncertainty and trade tensions, how is a shipbuilder not just staying afloat, but sailing ahead at record speed? We'll break down the numbers, look at what's driving this success, and what it all means for investors. Stick around because you won't want to miss this analysis. But before we dive in, just a quick disclaimer. This video is for informational and educational purposes only. It's not financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. All right, so first, who is Yangzijiang Shipbuilding? For those new to the company, Yangzijiang, or YZJ, is one of the largest and most prominent non-state-owned shipbuilders in China. Listed on the Singapore Exchange, they build a wide range of commercial vessels. We're talking everything from massive container ships to oil tankers and bulk carriers for customers all over the world. Now, the shipbuilding industry is a fascinating and complex beast. It's facing a mix of headwinds and tailwinds. On one hand, you have macroeconomic uncertainty and geopolitical tensions that can disrupt trade. We've seen global shipbuilding contracts fall by 54% in the first half of 2025, largely due to concerns over U.S. tariffs on Chinese-built vessels. But on the other hand, there's a massive structural shift happening: decarbonization. The International Maritime Organization is pushing for a net zero framework with mandatory emission limits and carbon pricing schemes. This is a huge opportunity for shipbuilders like Yangzijiang, as it forces shipowners to upgrade their fleets to newer, greener, more efficient vessels. So, with that context, let's look at the headline numbers from their first half 2025 report. Revenue came in at $12.9 billion, which was relatively flat with a slight 1.3% dip from last year. Gross profit. This is where the story gets exciting. Gross profit jumped an incredible 27.6% to $4.4 billion. Gross profit margin, this led to a record high gross profit margin of 34.5%, a significant leap from 26.7% in the first half of 2024. Net profit. As I mentioned, profit attributable to equity holders, or net profit, surged 36.7% to a record $4.2 billion. Net profit margin. The net profit margin also saw a huge expansion, hitting 32.5%, up from 23.4% last year. And earnings per share. This translates to a basic and diluted EPS of 106.02 RMB cents, up 37 from 77.42 RMB cents in the same period last year. So while revenue was steady, profitability went through the roof. The key question is, how did they do it? The report points to three main factors: lower steel costs, which is a major raw material, favorable pricing on their contracts, and the smooth delivery of large, technically sophisticated dual-fuel container ships, which command much better prices. Let's break that down further and look at their core business segments. First, shipbuilding. This is their bread and butter. Revenue here was $12.2 billion. What's interesting is the product mix. They began construction on more oil tankers, which have a lower unit price than container ships, slightly dampening the revenue figure. However, this was offset by building those large, technically sophisticated dual-fuel container ships, which command much better prices. This segment's gross margin was an impressive 35%, a big jump from 26% a year ago, thanks to those lower steel costs and better contract pricing. Next up is the shipping segment, where Yangzijiang owns and charters out a fleet of 33 vessels. This segment saw a 15% decline in revenue to $511 million. This was mainly due to weaker charter rates for bulk carriers during the period. As a result, the gross margin here fell to 26% from 41% last year. This shows the volatility in the shipping market, but also highlights the strength of their core shipbuilding business right now. So, how did these results stack up against expectations? While specific Wall Street consensus numbers for the half year are hard to pin down, we can look at analyst sentiment leading up to the report. Analysts had a moderate buy consensus on the stock, with an average price target suggesting upside potential. More importantly, the company's performance on its own targets is very telling. They had a full year 2025 order win target of $6 billion. In the first half, they secured $0.54 billion in new orders, which is about 9% of their target. They also secured another $0.2 billion in July. While this might seem low, management noted these were for small to mid-size vessels, and they are confident in filling the remaining delivery slots for 2028 and 2029. On the delivery front, they are well on track. They delivered 23 vessels in the first half, hitting 41% of their full-year target of 56. They delivered another 6 in July, showing strong execution. To get a sense of the management's perspective, let's turn to the executive chairman and CEO, Mr. Ren Letian. He said, quote, "We remain focused on executing a robust order book with high quality and timely delivery amidst macro headwinds in first half 2025. The record high gross margin of 35% attained during the period is a testament not only to our industry-leading capabilities in building sophisticated vessels, but also to our efficient on-site execution." This quote really reinforces the key message of this report. Despite a challenging external environment, their operational efficiency and focus on high-end, profitable vessels are driving record results. Looking ahead, what can we expect? Yangzijiang is sitting on a massive outstanding order book of $23.2 billion. This gives them incredible revenue visibility all the way through 2029 and beyond. A key highlight is that green vessels, those powered by cleaner energy like LNG and methanol, account for a massive 74% of this order book's value. This positions them perfectly to capitalize on the industry's shift to decarbonization. They're also investing in future growth. First, Project Hongyuan, a capacity expansion project to be completed by the end of 2026, which will add about 17% to their existing site area. And second, an LNG terminal business. They're also building an LNG terminal, scheduled for completion in the first half of 2027. The company remains cautiously optimistic. They see the long-term demand driven by the green transition as very resilient. Now, how did the market react? Given the report was just released on August 6th of 2025, we'll be watching the stock, ticker BS6 on the Singapore Exchange, closely in the coming days. Typically, a profit beat of this magnitude combined with record margins and a strong order book would be viewed very positively by the market. Leading up to this, analyst ratings were generally bullish, with firms like DBS and UOB Kay Hian rating the stock as a buy. They pointed to the company's earnings visibility and strong track record as key strengths. We will have to see if this strong report leads to price target upgrades. So let's pull this all together. What does it mean for you, the investor? First, the bull case and the opportunities. One, massive order book. $23.2 billion provides a very stable and predictable revenue stream for years to come. Two, margin expansion. The jump to a 35% shipbuilding margin is huge. It shows they have strong pricing power and are managing costs very effectively. 3. Green vessel leader. With 74% of their order book in clean energy vessels, they are at the forefront of the most significant trend in the industry. 4. Fortress balance sheet. They are in a net cash position of $18.3 billion. This financial strength allows them to invest in growth and return capital to shareholders. And 5. Shareholder returns. The company has a history of dividends and has been actively buying back shares. Now, for the bear case and the risks. 1. Macro and geopolitical risks. Tariffs and trade wars are a real threat to the shipping and shipbuilding industries. 2. Slowing order wins. While the order book is huge, the pace of new orders in the first half of 2025 was slow. 3. Cyclical industry. Shipbuilding is historically a cyclical industry. A global recession could still impact demand. And 4. Shipping segment volatility. The weaker performance of their shipping charter business shows it's exposed to fluctuating freight rates. Overall, Yangzijiang Shipbuilding has delivered an exceptionally strong set of results. They are executing flawlessly on their massive order book and are a key beneficiary of the global push for greener shipping. While risks remain, their financial strength and market leadership position them well for the future. And that's a wrap on Yangzijiang Shipbuilding's first half 2025 earnings, record profits, expanding margins, and a clear strategy for the green future of shipping. What are your thoughts on these results? Are you bullish on the shipbuilding industry? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and don't forget to subscribe to the channel for more deep dives into the companies and markets that matter. Thank you for watching, and I'll see you in the next video.